We're now going to learn how to do the calculations as well as the journal entries for depreciation of property, plant, and equipment. As you guys can see here, Wiley is pointing out to us the definition for depreciation is that it is in fact a process of allocating to expense the cost of a plant asset over its useful life in a rational and systematic manner. Make sure that you read that definition again on your own and that you definitely understand each little part of that. It's definitely a process. We're going to be allocating to expense, specifically the account depreciation expense, the cost, in other words, what we paid for that particular asset, either all of it or the majority of that cost, over the asset's useful life. So whatever the item is, over the time frame that we are using it to help us earn revenues, we're going to expense out what we paid for it. In a rational and systematic manner is referring to the three different ways for our class in particular that I'm going to show you how you could calculate it. Management gets to make some decisions, and this is one of those decisions. We've talked in a prior chapter about management gets to select their inventory cost flow and the system that they want to use, periodic or perpetual. Same kind of thing applies here with depreciation. So I'm going to show you three basic calculations for depreciation, but I do want you to know that there are other ones out there. But they're beyond the scope of this particular class. So if you guys go to work somewhere and somebody starts talking about depreciation and they say some things that you haven't heard us discuss in this class, just understand that they may be, performing a different calculation. There are some other ones out there. We will be calculating depreciation against assets that are land improvements, buildings, and equipment. I mentioned to you in a prior video that we will not be depreciating out land. And think about the fact that it is a depreciable asset, because if you really think about what happens with these kinds of assets, land improvements, buildings, and equipment, their revenue producing ability will decline over the asset's useful life. So we wear and tear down equipment and our land improvements. Our buildings need to be refurbished every so often because of the wear and tear on them. So they lose their revenue producing ability, or to help us generate revenues over their useful life. Notice here that they're saying land does not depreciate because it does not wear out. It's pretty much not going anywhere, or at least we hope not. Alright, so moving on into our slide set here, you guys need to make sure that you are able to capture the numbers that go along with these words. Alright, so on this first one right here, you guys are going to hear me say historical cost. I talked to you earlier about writing down, for example, HC for historical cost. And we've talked about the fact that you are going to total up a bunch of numbers to come up with the amount that you are booking the asset for at the time of purchase. Okay, so that's the number that I'm talking about here. All expenditures necessary to acquire the asset and make it ready for its intended use. We're going to grab that dollar amount and we're going to call that cost or historical cost. I'm going to differentiate that number from something else we have to calculate. So I need for you to make sure that you're writing down historical cost, or HC, for that particular value. The next thing we see here is useful life. There are some prescribed useful life in years for certain types of assets. I want you to know that the IRS gives some documentation. The FASB and others provide documentation to companies in regards to how many years you can depreciate a certain asset over a certain number of years. For us, we're not having to look them up, okay? So you're not having to go look these things up. These number of years of useful life are going to be given to you in your homework as well as on your test. But just understand that this is the amount of time that the company estimates that they are going to be using this particular asset for. So it's the estimate of the expected life based on the asset's need for repair, its service life, and even its vulnerability to obsolescence if applicable. Okay, so it's going to be a quantity of years. You guys need to keep in mind in the back of your head that occasionally you might have to be tweaking your numbers a little bit to give me or Wiley the useful life and applying it in number of months instead of number of years. So be careful with your annual amounts and your monthly amounts and your quarterly amounts when you're thinking about how these numbers are working out. And then lastly, we've got salvage value. This is going to be another dollar amount that is going to be given to you in the data set for your homework and for the test and the comprehensive final exam. So you're going to hear me or see me type up on Excel or on a Word document SV for salvage value. So we had historical cost or HC for this one, and over here we've got salvage value. We're going to use this in some of our formulas. So just make sure that you understand that salvage value is what we estimate that the asset's value will be at the end of its useful life. So when we're done with it, how much will it likely be worth to another party, for example, at that time when we're finished with it, okay? So notice too, we've got another helpful hint down here at the bottom of this particular slide. I mentioned to you all earlier that there will be journal entries done. We've kind of talked about these throughout the semester, that depreciation expense is an expense account and that it does get shown on the income statement. And then accumulated depreciation hyphen whatever asset we're talking about here, land improvements, hyphen equipment, or hyphen buildings, those assets will have one of these accumulated depreciation accounts, which is of course the contra asset, because we would subtract that accumulated depreciation amount from that asset in order to show us, for example, equipment, net. So accumulated depreciation is reported on the balance sheet as a deduction from plant assets. All right, the three methods that I'm going to show you guys how to do are listed here on this particular slide. The straight line method is fairly easy. As you guys can see here, at some point in time, Wiley or someone went and evaluated the use of depreciation methods by major U.S. companies. So in other words, they did a review of, for example, a bunch of major U.S. companies' 10Ks, which are their annual reports, and found that 83% of those major U.S. companies are in fact applying the straight line method. We can also see some other ones. The declining balance method. The one that I'm going to show you is called the 200% or double declining balance method. But I do want you to know that there are other percentages besides double or 200% that can be applied by companies. So I mentioned a few minutes ago that there are some other ones that you guys may see once you are out there in the world of business. And then lastly, we've got units of activity method. That one is also fairly simple. The declining balance method one is the one that many of you seem to have more challenges with. So number 1 and number 3 are pretty easy, but that middle one you're going to have to focus very carefully on what I'm telling you and then also how you calculate it. Again, on this illustration here, note that Wiley has also said that their 8% were using other. Again, there are several other methods out there beyond the scope of this class. All right, so management gets to select the method that they believe best measures the asset's contribution to revenue over its useful life. All right, so let's take a look here at our data set. We're going to use this data set for these three particular examples. All right, so Bill's Pizzas purchases a small delivery truck on January 1st. Okay, so the first day of a calendar year here. The cost, $13,000. That $13,000 is going to be several numbers added up together. Okay, so the purchase price plus sales tax plus maybe some wrapping or painting of the vehicle. And then we've got the expected salvage value of $1,000. So here I've got the HC, historical cost, $13,000, and the SV, or expected salvage value, of $1,000. We are definitely going to need those two numbers right there for the method that was listed first, the straight line method, as well as the units of activity method. Okay, so method number 1 and method number 3, we have definitely got to grab historical cost of $13,000 and the salvage value of $1,000 for those two methods. Next, they have listed for us that our expected or estimated useful life in years is 5. If you guys were to calculate that out into months, that would be 60. So 5 times 12, excuse me, equals 60 months. And then notice here that they have also given us an estimated useful life in miles. Okay, so miles, because it's a delivery truck, and they believe they're going to drive it 100,000 miles before they decide to get another vehicle. Okay, so maybe they've limited their use on this particular truck to 100,000 miles. I do want to say here that if this was a machine that we were purchasing instead of a vehicle of some sort, that if it was a machine, instead of saying estimated useful life in miles, it could actually say in hours. All right, so if I've got anybody in the class that, for example, has ever had a dirt bike or a four-wheeler, a bass boat with a motor on it, all types of large, heavy equipment and other things, oftentimes they keep up with the number of hours that the engine has ran instead of the number of miles a vehicle has been driven. So we could use miles or hours as our units of activity in our units of activity calculation. All right, so we're now going to learn how to compute depreciation using the following methods. Okay, so we've got the straight line, which earlier was method number 1, and then units of activity was method number 3 on our list. These are the two that I was talking about that we have got to take HC and SV and use them in our calculation. And then the declining balance one is a little bit different. We're not going to immediately start out by calculating something with these two numbers. Instead, we're going to do something else. So just make sure that you're very methodical in your notes for the videos that I'm about to do on covering these items. All right, so I just wanted to give you an intro there of the data for our methods, but I'm going to do separate methods for each, or excuse me, separate videos for each one of these methods next.